Good day. Today, we will discuss the first chapter of this course, which is Understanding Financial Statements. You may ask, why do we need to study financial statements? Let us put it this way. For example, assume that you are a manager deciding whether to acquire another company or divest of a current division. Or imagine yourself as an equity or credit analyst. How do you assess and communicate an investment appraisal or credit risk report? Very good. Through reading the financial statements. That is the reason why we need to study and understand financial statements. So for this chapter, you are expected to understand how business activities are reported through the financial statements. Second, enumerate the sources of information about a business enterprise. Third, identify the required financial statements and know how they are interconnected. And fourth is to know the nature and significance of the four financial statements. What are these? These are the balance sheet statement, the statement of comprehensive income, and the statement of stockholders' equity and statement of cash flows. So here is the presentation outline. So basically, we have 13 topics. But for this video, I will just discuss to you the first half of this chapter. Okay, for the first topic, how business activities are reported. So to be able to analyze a company effectively or infer its value, it is important that one must understand the company's business activities. And this can be accomplished through the financial statements. Financial statements report on a company's performance and financial condition and reveal executive management's privileged information and insights. And financial statements serve the needs of different users. So the operation of the accounting information system involves application of accounting standards to produce financial statements that provide insights on the business activities of the company under analysis. Accounting information should be used in the business context in which the information is created. Okay? Please understand that all companies without exception plan business activities, finance those activities, invest in those activities, and then engage in operating activities. So business firms conduct all these activities while confronting business forces, including market constraints and competitive pressures. Financial statements also provide crucial input for strategic planning, as well as information about the relative success of those plans, which can be used to corrective action and make new operating, investing, and financing decisions. Okay, so what are the general objectives of financial statements? First, we have providing information for economic decisions. When we say economic decisions, these are taken by the users of financial statements that require an evaluation of the ability of an enterprise to generate cash and cash equivalents and the timing and certainty of their generation. This ability ultimately determines the capacity of an enterprise to pay its employees, suppliers, meet interest payments, repay loans, and make distributions to its owners. Second, providing information about the financial position. Okay, please take note that financial position of an enterprise is affected by the economic resources. So what are these economic resources? First, we have information about the economic resources controlled by the enterprise and its capacity in the past to modify these resources is useful in predicting the ability of the enterprise to generate cash and cash equivalents in the future. Another one is information about financial structure is useful in predicting future borrowing needs and how future profits and cash flows will be distributed among those with an interest in the enterprise. Third, information also is useful in predicting how successful the enterprise is likely to be in raising further finance. Information about liquidity and solvency is useful in predicting the ability of an enterprise to meet the financial commitments as fall due. Liquidity refers to the availability of cash in the near future after taking account of financial commitments, and solvency refers to the availability of cash over the longer term to meet financial commitments as they fall due. Okay. So those are the economic resources that are affected. The third objective of financial statement is providing information about performance of an enterprise. So another important objective of the financial statements is that it provides information about the performance and in particular its profitability, which is required in order to assess potential changes in the economic resources that are likely to control in future. Information about variability of performance is important and useful in predicting the capacity of the enterprise to generate cash flows from its existing resource base and informing judgment about the effectiveness with which the enterprise might employ additional resources. The fourth one is providing information about changes in financial position. So basically, the financial statements provide information concerning changes in the financial position of an enterprise, which is useful in order to assess its investing, financing, and operating activities during the reporting period. This information is useful in providing the user with a basis to assess the ability of the enterprise to generate cash and cash equivalents and the needs of the enterprise to utilize those cash flows. Okay. Now let's move on to the next topic, which is the demand for financial accounting information. So who needs this financial accounting information? First one, we have the managers and employees. Why the managers and employees? For their own well-being and prospective earnings, potential managers and employees need accounting information on the financial condition, profitability, and prospects of their companies, as well as comparative financial information on competing companies and business opportunities. Management uses financial statements to raise financing for the company. to meet disclosure requirements and to serve as a basis for executive remuneration and bonuses for wage negotiations and to meet disclosure requirements. Why employees? Because as an employee, you are a stakeholder of the corporation. So it is just right that you know the financial status of the company because you are working for that. Second one is investors and analysts. Financial statements are used by these parties to decide whether to buy or sell equity shares. Because of course, the very reason why you invest in such company is to maximize your profit, to earn income. So how would you decide? How could you make a decision whether to buy or to sell your equity shares if you don't know the financial status of the company? And where to find it? Through the financial statements. Expectations about future profitability and the ability to generate cash influence the price of securities and a company's ability to borrow money at favorable terms. Other information intermediaries, such as financial press writers and investment analysts, are interested in predicting companies' future performance. The third, creditors and suppliers. Okay. So why creditors and suppliers demand for financial accounting information? Creditors, example, the banks and other lenders. So they need financial accounting information to help determine loan terms, the loan amounts, the interest rates, and required collateral. Why would the creditors extend loans to the corporations if they don't have the capacity to repay its loans? So, of course, the creditors, for example, the banks and the lenders, need to see the financial accounting information of the company. Suppliers also demand financial data to establish credit terms and to determine their long-term commitment to supply chain relations. Both creditors and suppliers use information to monitor and adjust their contractual requirements and environment with a business firm. The fourth one is shareholders and directors. So financial accounting information are needed by, of course, the owners and directors of the company to assess its profitability and risks, to evaluate managerial performance, and to help make leadership decisions. Take note that as a shareholder of the company or as the owners of the company, you have to make leadership decisions also for the directors. So how to make these decisions? What would be the basis? Through the financial accounting information. Because in the financial accounting information, you can assess the performance of the business. Fifth one is the regulatory and tax agencies. So who are these regulatory and tax agencies? So the SEC, the Securities and Exchange Commission, the BIR, the Bureau of Internal Revenue, BSP, Bangko Sentral ng Pilipinas, and other legal institutions demand financial accounting information to monitor the business firm's compliance with laws, for public protection, price setting, and for setting tax and other regulatory policies. Now, you may ask why customers and potential strategic partners demand for financial accounting information. Customers, both current and potential, need accounting information to evaluate a company's ability to provide products and services as agreed and to assess the company's reliability and staying power. Potential strategic partners would wish to estimate the firm's profitability to assess the fairness of returns on mutual transactions and strategic alliances. So, of course, you're a customer. You really like this product. Okay? So, you need to assess the staying power of this company. If this company can provide the products and services that you need. Other decision makers. Financial accounting information are required for varied purposes by other parties from assessing damages for environmental abuses to making policy decisions involving economic, social, taxation, and other initiatives. So these are the groups or the people that demand for financial accounting information. Now, let's move on to the sources of information about business enterprise. So in general, the quantity and quality of accounting information that companies supply are determined by managers' assessment of the benefits and costs of disclosure. In the Philippines, publicly listed companies must file financial accounting information with the SEC or the Securities and Exchange Commission. So these are, okay, what are these information? First, we have the audited annual report that includes the 4 financial statements. Again, what are the 4 financial statements? We have the statement of financial position, or known as the balance sheet statement. We have the statement of comprehensive income. Third, the statement of stockholders' equity. And fourth one is the statement of cash flows, with explanatory notes and the management's discussion and analysis of financial results. Second one is the unaudited quarterly or interim reports that include summary version of the 4 financial statements and limited additional disclosure. So all other registered corporations and partnerships are likewise required to file annually audited financial statements with accompanying explanatory notes with the SEC. Okay, so let's talk about disclosure. Okay, this is about disclosing information, especially now. For example, we can relate this, especially now that we are into social media. So what are the benefits if you disclose too much in social media, in your social media accounts? Okay, I will leave that question to you. We will just focus on the benefits of disclosure for the company. So the advantages of supplying accounting information extend to a company's capital, labor, input, and output markets. Companies compete in these markets. Okay? Again, company competes in the 4 markets. We have the capital, the labor, the input, and output. For instance, debt and equity financing are sourced from capital markets. And the better a company's prospects, the lower will it be its cost of capital as reflected in higher stock prices or lower interest rates. The same is true for a company's recruitment efforts in labor markets and its ability to establish and maintain superior supplier-customer relations in the input and output markets. So, if you disclose your company, that the company is doing well in the industry, in the market, you could attract more investors, you could attract more talents to join in your company. The company's ability to disclose reliable, so these are audited accounting information about its products, processes, and other business activities, enable them to better compete in capital, labor, input, and output markets. Now, if there are benefits of disclosure, there are also costs of disclosure. The preparation and dissemination cost of supplying information, accounting information, can be substantial, and the possibility for information to produce competitive disadvantages is high. Companies are apprehensive that disclosures of their activities, such as product or segment successes or failures, strategic initiatives, technological or systems innovations, could harm their competitive advantages. Companies also face possible lawsuits when disclosures create expectations that eventually are not met. Disclosure costs, including political costs, are high for highly visible companies, such as the large telecommunication conglomerates. All companies and software companies, because they are favorite targets of public scrutiny. Okay. Now, so what are the constraints of relevant and reliable information? First one, we have timeliness. So if there is an undue delay in the reporting of information, it may lose its relevance. For example, the monthly report for the month of October will be presented, October 2020, for example, will be presented to you on January 2021. So what's the use of the report? You could not make a real-time decisions. It would just become a history. So management may need to balance the relative merits of timely reporting and the provision of reliable information. To provide information on a timely basis, it may often be necessary to report before all aspects of a transaction or other event are known, thus impairing reliability. Conversely, if reporting is delayed until all aspects are known, the information may be highly reliable but of little use to users who have had to make decisions in the interim. In achieving a balance between relevance and reliability, the overriding consideration is how best to satisfy the economic decision-making needs of users. Second one is the balance between benefit and cost. So the balance between benefit and cost is a pervasive constraint rather than a qualitative characteristic. The benefits derived from information should exceed the cost of providing it, of course. The benefit should exceed the cost. Okay, take note of that. The evaluation of benefits and costs is, however, substantially a judgmental process. Third is there should be a balance between qualitative characteristics. So in practice, a balancing or trade-off between qualitative characteristics is often necessary. Generally, the aim is to achieve an appropriate balance among the characteristics in order to meet the objective of financial statements. The relevant information of the characteristics in different cases is a matter of professional judgment. And the last constraint of relevant and reliable information is the true fair view of fair presentation. Financial statements are frequently described as showing a true and fair view of the financial position, performance, and changes in financial position of an enterprise. Although this framework does not deal directly with such concepts, the applications of the principal qualitative characteristics and of appropriate accounting standards normally results in financial statements that convey what is generally understood as a true and fair view of such information. So these are the four constraints of relevant and reliable information. Okay, now let's move on to the financial statements. Okay, so this is the figure of how the financial statement links across time. Okay, so business activities are periodically reported by companies using the four financial statements. We have the statement of financial position, we have the statement of comprehensive income, the statement of stockholders' equity, and the statement of cash flows. Okay, so this figure shows how these statements are interconnected across time. A statement of financial position reports on a company's financial position at a point in time. Okay, this one, the statement of financial position beginning of period. The statement of comprehensive income, the statement of stockholders' equity, and the statement of cash flows report on performance over a period of time. So this statement of cash flows, stockholders' equity, and comprehensive income over a period of time. Well, the statement of financial position at a point in time. Okay. So the three statements here, these three statements, cash flows, stockholders' equity, and comprehensive income, link the statement of financial position from the beginning of the period to the end of the period. Okay. So the linkage of financial statements. The four financial statements are linked with each other and link across time. This linkage is also known as articulation. And the statement of financial position and statement of comprehensive income are linked via retained earnings. Okay, we will have an in-depth discussion on the financial statements on its linkages on the next video. Okay, I would like to acknowledge the source. Okay, this is the source as shown there. Okay, and thank you for watching. Have a good day.